A very good evening to everyone present. We welcome you to the 11th edition of the Sri Ram Economic Summit 2022, Asia's largest undergraduate economic summit brought to you by ACCA. For today's discussion, we are delighted to have with us experts from one of the fastest growing companies in its domain, Marcellus Investment Managers. Specializing in capital allocation services, the company's purpose is to make wealth creation simple and accessible by being trustworthy and transparent capital allocators. Our esteemed panel comprises the honorable founder and CEO of the company, Mr. Saurabh Mukherjee. Mr. Mukherjee was a bachelor's and master's in economics. Rated as a leading equity strategist, Sir was the CEO of Ambit Capital before he set up Marcellus. We are honored to have the privilege of hosting you, sir. We also have with us distinguished experts from the Marcellus Investment Managers, Mr. Salil Desai, a chartered accountant and a postgraduate diploma holder in business management, and Mr. Rakshit Ranjan, a BTech from IIT Delhi and a CFA charter holder. On behalf of everyone present, I extend my heartfelt welcome to all the speakers.
Thank you. Thank you.
Where to invest in order to get good returns? This is a question that troubles every person who is looking for opportunities to invest their hard-earned money. With time, people have realized that investing their life savings in physical assets might not generate adequate returns to meet their goals. On the other hand, those who have delved into the stock markets have lost huge sums of money due to various reasons. So, where should we invest then? The Marcellus Investment Managers, with their experience, expertise, and detailed research, offer a solution. Their book, called Diamonds in the Dust: Consistent Compounding for Extraordinary Wealth, provides insight into how we, as Indians, can identify and incorporate investment techniques in order to maximize returns. An all-encompassing guide to investing, this book busts many common myths and provides simple yet effective strategies. Before we begin with today's session, the audience is encouraged to type their questions in the chat box, and we will take them up post the session. Without further ado, to enlighten us more on this topic, I would request our speakers to take over.
Thank you. Thank you very much, Afra. And thank you to SRCC for inviting Rakshit, Salil, and myself to speak to you guys this evening. I'll load up a set of slides and we'll use those to make it a little bit more sort of visual rather than us just having a voiceover. So I think, as Afra mentioned, Rakshit and Salil look after the best part of the best part of $2 billion now for our clients. Rakshit runs the flagship product, which is called Coffee, the Consistent Compounders portfolio. He's also the co-author with me of the book Coffee Can Investment. Salil looks after our advisory portfolios. And as I said, our job, thanks to experts like Rakshit and Salil, is to give hardworking Indian families a clean portfolio which has rational capital allocators. Most Indian promoters don't know how to allocate capital rationally. They do it for reasons other than rationality. And the third thing, beyond cleanliness and rationality, we look for in companies is we invest in dominant companies, right? In plain English, someone might say we invest in monopolies, right? So clean, rational, dominant, that's what we do with the best part of $2 billion. Now, you guys might be wondering, given that you're studying in a center of excellence in Indian academia, you will be wondering, it's all very good, Marcellus does it, but why does Marcellus bother writing books about it? Why give away the best part of 20 years of our intellectual property in these books which sell by the lakhs? The answer is in this slide, right? One of the things we have realized over the last 5 years or so is that whilst there's a lot of excitement about the Indian stock market, right? There's a lot of excitement about investing these days. I'm sure you must have been reading that every year Demat accounts are going up by 70%. I think 2 years ago, the number of Demat accounts in India was around 10 million. Now it's 25 million. So literally by the tens of millions, Indians are entering the stock market. But what we are seeing is that, forget the newbies, forget the new people entering the market, even most Indian fund managers don't actually understand how difficult it is to consistently make money in the Indian stock market. And we've given you some basic numbers here, just so that you guys at a very early stage of your careers get a sense of how challenging the Indian stock market it is. The Indian stock market has no equal in the world in terms of how polarized it is. Let's start with the good news. The good news is over the past decade or so, the Indian stock market has created $1 trillion of wealth, right? That's quite a big deal in a country where the market cap is around 2.7 trillion. $1 trillion has been created in the last decade alone, right? Now, where it gets quite challenging is out of this 1 trillion, no more than 16 companies, less than 1,500 companies have accounted for 80% of that 1 trillion, right? 80% of the wealth created by the Nifty over the last decade has come from just 16 companies. And why is that? It's not very hard to see why that is, because we have created an ecosystem where just about 10 companies account for 90% of the nation's profits, right? It's an insane situation. No other country is as polarized as this. 10 companies account for 90% of the country's profits. Now, obviously, there will be therefore a dark side of the Indian market, and that's the dark side which makes investing in India very challenging. If you looked at the market as it stood a decade back, nearly half the companies that were in the BSE 500 a decade back are no longer in the picture, right? They've just disappeared and they're just vaporized from the BSE 500. And again, if you looked at the market in terms of returns, 85% of the BSE 500 as it stood a decade ago has given a miserable return. By miserable, I mean a rate of return below your and my cost of capital. Now, why is this? Why do the vast majority of companies, the vast majority of companies you and I are aware of in India, why do they disappoint? The reason they disappoint is the vast majority of companies in our country are actually quite poorly run. So 70% of the Nifty 50 companies, I'm deliberately choosing Nifty 50 because that's seen as the commanding heights of the Indian stock market. 70% of Nifty companies give you a rate of return lower than the cost of capital. And those of you who are studying economics, studying finance in SRCC will know that if a company doesn't give a rate of return, doesn't generate a return on capital, at least commensurate to its cost of capital, it's a waste of time, right? So it's this polarization, right? A small group of companies, one and a half dozen companies, which are the diamonds, and then thousands, literally thousands upon thousands. The Indian stock market has 6,000 companies. Barely 15, 16 out of them actually make any money. The rest of the 5,885 are a waste of time, right? We can imagine why we call the book Diamonds in the Dust. Now, what can you do? What can you do at the outset of your career to make it easier for you as you begin your journey into the world of investing in finance? How can you identify more diamonds than any other people in your generation, right? There's a bunch of techniques we've outlined in the book. I'll request my colleague Salil to take you through them. Salil, over to you.
Thanks, Saurabh. Right. So, before you think of making money from the stock markets, right, the first thing that you have to do is know how not to lose money. Right? Before you make money, you make sure that you don't suffer losses. And the sure way of losing money is to invest in companies where there is fishy accounting. And there are tons of examples of this, right? You all may be too young to remember a company called Satyam Computers, but there was ILNFS, which happened relatively more recently. And these are mega accounting frauds that happen in India. But it is not the case that only large mega companies like Satyam and ILNFS go through this. Right? There are several small examples across the spectrum of companies where people end up losing money. Right? To give you some examples, there used to be a company called Divan Housing Finance. At peak, this company was valued at about 20,000 crores. Forensic audit was kind of commissioned for this company, and they found out that in a period of 3 years, 17,000 crores was siphoned off from this company by the company's owners. Right, so the company which was valued at 20,000 crores, siphoning off of 17,000 crores in just a matter of 3 years. Then there was a company called Deccan Chronicle. It used to be a leading English language newspaper from the south of India. This company had to restate its debt upwards by 5 times in a matter of 1 year. Right. So what should ideally have been a 4,000 crore debt was shown in the balance sheet only at 1,000 crores. So if somebody invested thinking that 1,000 crores is a manageable debt, would have been for a big shock at the end of the year when this went up by 4 times. And it's not that they borrowed more, it's just that they had understated the debt. And then there was a company called Cox and Kings. This used to be a pretty large travel services company. This company had a positive net worth on 31st March 2019 of about 4,700 crores, which puts it in the league of reasonably large companies. But by the end of March 20, because of a lot of accounting jugglery that they had done in the past, they had to restate their net worth, and it ended up being at 7,300 crores negative. Right, in a span of 12 months, there was a 12,000 crore swing in the net worth. So that's 1,000 crores of net worth getting knocked off from the balance sheet every year. Now, this is all fine, but why should you and I really worry about it? Right? Frauds happen, fine. Stay away from them. No, that does not happen, because retail investors invariably get trapped into investing in such companies. And why does it happen? Right? Again, we go back to the DHFL example that we talked about earlier. If you look at the chart on the left, that shows that the blue line is the stock price, and the dashed line is the retail shareholding. Retail shareholding is people like us, right? Our families. When they invest in the stock market, they are called as retail investors. So when there were murmurs that something is wrong with DHFL, and the stock price started declining, which included a 40% fall in one day, 40% fall in a single day of the stock price. What happens after that? In the next 15 to 18 months, retail shareholders who used to own about 18% of the company ended up owning almost 50% of the company, right? So half of the company was owned by retail shareholders after the stock price has fallen 40% and the fraud is out. Today, this company has been delisted, right? It has been taken over by another company under the insolvency code, and the value of equity is zero, right? So this 50% retail owners, for whatever they bought it at, they got nothing out of this company, right? Zero, zilch. Now, why does this happen? There are three ways in which retail investors typically get trapped. The first is that they obviously don't have the necessary tools, right, to detect any fraud in advance. Right? They're laymen. They wouldn't really know accounting in depth to figure out if there is something wrong. If you know something is wrong, you will obviously not invest. The second is that a lot of people are aware that there's something wrong going on, but they think they're smart enough to exit before it is out in the open. But that rarely ever happens, because as a retail investor, you will be the last to know if there's something wrong in the company. Right? It's a smaller group which will always be aware of this much earlier. The third and the most common reason why retail investors get trapped is that they think that after a stock falls significantly, right? So in this case, a 40% decline has made the stock cheap, right? In quotes. So what was available at 100 yesterday is available at 60 today. Right? So 40% discount, you should go and buy it, right? But turnarounds are very, very rare in such cases, right? In fact, in most accounting irregularities, you will very rarely find the company comes back. So these three reasons are why retail investors necessarily avoid accounting frauds. And what do you need to do that is you need a forensic accounting checklist, right? And a governance checklist. In the book, we have given a list of accounting ratios, a list of qualitative checks that you can do from publicly available information, which will tell you enough about where not to invest. The question is that where to invest. So I'll request Rakshit to take you through that step. Rakshit, please.
Thanks, Salil. So, folks, when it comes to generating alpha or outperformance versus the broader stock market, there's an interesting data point about India's stock market which is worth bearing in mind, which is that indices such as Sensex or Nifty 50, they do not outperform even India's nominal GDP growth rate, despite the fact that such indices, they naturally benefit from survivorship bias and selection bias versus the broader economy. The broader economy has all sorts of bankruptcies and weak companies, whereas the benchmark indices have only the most successful and larger and typically growing companies biased in the index. Now, despite this sort of a bias, the lack of outperformance of these indices versus nominal GDP growth of the country, we believe is largely due to the dodgy accounting practices followed by many large and dominant businesses in India, just like Salil elaborated in the previous slide, right? And hence there's a massive alpha to be had only by focusing on clean accounting practices itself without doing anything else. Now, in addition to the alpha from clean accounting practices, there is another layer of alpha that can come from picking up companies with high quality fundamentals, not just clean accounts, but also high quality fundamentals. Now, what are high quality fundamentals? There are three characteristics broadly you should look out for. Firstly, the firm should have a high pricing power. what does pricing power mean? It doesn't just mean the ability to hike prices in order to protect margins in the face of rising raw material costs. High pricing power should also mean that even if a competitor kicks off a massive price war, right, by offering competing products at say 30 or 40% discounted price points, then even such a price war should not lead to any adverse impact on either the market share or profitability of a high quality franchise. In the book Diamonds in the Dust, there's chapter number 4, which will give you more than 10 case studies of companies that have exhibited high pricing power by this definition of rigorous degree of competitive advantages. The second characteristic of a high quality company is that the outcome of high pricing power, which naturally is high cash generation, high return on capital employed, this outcome should get, or the high cash flows should get reinvested in the business whilst also sustaining high pricing power in the incremental avenues of investment. Now, this is harder than it sounds because most successful businesses, they fail to maintain prudence when they allocate capital to grow beyond their core business. And hence in the book, you'll see several examples to learn from, more than 20 odd such examples, learn from prominent successful Indian companies, majority of which, unfortunately, had an adverse impact on total shareholder returns because of their capital allocation decisions. And the third characteristic of a high quality company that you need to look out for is that these companies should be institutions rather than just one-man shows, right? Lala Ji ki Dukaan is not what you're after. You should be looking for institutions. And institution building at such companies needs to happen at 3 levels broadly. First of all, board of directors should be high quality members, relevant backgrounds, and independent culture. Secondly, the CXO layer, it should be high quality of professionals appointed through a process rather than just ad hoc ways of appointing when the succession event happens. And third, you need to have decentralized execution of the business at a ground level through systems and processes, right? And in this book, we've actually given some very interesting comparisons, let's say between Asian Paints and HDFC Bank on let's say quality of the board, quality of CXOs, etc. To most investors, they are very similar, but if you go deeper, there are differences worth understanding, right? Now, there are some very interesting rewards from building a high quality portfolio. The first layer of reward is the chart on the left, which is that consistent compounders, they grow their share prices at, let's say, 25, 27, 23% sort of CAGRs, which effectively means their share prices become 10x in 10 years, 100x in 20 years. And the share price chart on the left shows you how Asian Paints has demonstrated that as a consistent compounder over the last 2 decades, right? But what's even more interesting as a layer of outcome is the histograms on the right, right? These histograms show the last 20 years of share price performance of Asian Paints broken down into 12-month time periods. And what's quite interesting is that when you break the 12-month experience into buckets of different types of returns, so let's say 0 to 10% return in a financial year, 1st April to 31st March, 10 to 20, 20 to 30, like that. If you make a histogram out of that, what's quite remarkable is the consistency on the right-hand side half of an Asian Paints equivalent consistent compounder, which is the chart on the top, versus complete lack of consistency in the chart at the bottom, right? Now, not just it's the lack of consistency. What's even more interesting is that the tallest tower in the chart on top is more than 30%, whereas the tallest tower in the chart at the bottom, which is Nifty 50, it's only 10 to 20%. Now, how does this really play out for an investor? So think about it like this. Last year or two has been the time of euphoria after the COVID crash, let's say, of 2 years ago, right? There's a massive crash and then the market recovered. A very similar thing happened after the global financial crisis, right? The market fell by 55, 60% during FY09. And hence you can see both the histogram on the top, which is Asian Paints, as well as Nifty 50, FY09 was a massive negative year. But when you look at FY10, clearly it was more than 30% for both Nifty 50 as well as Asian Paints, right? What's interesting is what happened after FY10. After the initial recovery, when you look at Asian Paints, FY11 was 20 to 30%, FY12 was 20 to 30%, FY13 was more than 30, FY14 was 20 to 30, FY15 was more than 30, so on and so forth, right? Whereas for the Nifty 50, FY11 after FY10 recovery, FY11 was only 10 to 20, FY12 was negative. FY13 was only 0 to 10, FY14 was only 10 to 20, FY15 was again 20 to 30. Now, what this is telling you is, if you time entry exit in an Asian Paints, which is you've had a massive recovery after say FY10, and then you try to exit waiting for a better price point to re-enter, that doesn't happen, right? You stay invested, you get the compounding of the chart on the left. Whereas for Nifty 50, if you have the hand of God on your head, maybe timing is beneficial. Maybe if you had exited after FY11, FY12 was a negative area, it would have given you a better entry point. So effectively, the risk of timing entry exit goes away the moment you pick up a high quality franchise like a consistent compounder. And more on this risk of timing from Salil in the next slide. Salil, over to you.
Thanks, Rakshit. Right. So taking off from where Rakshit left off, now let us look at two sets of data to drive home 2 points. The first is that you can't time the market, right? No, how much ever we would like to think that this is the right time to enter, this is the right time to buy, it's the right time to sell, we can't do it. And the second point we'll try to make is that even if through some gift that you received from the Almighty, you're able to time the market, it still does not really make too much of a difference to your returns, as long as you're investing in good quality stocks of the kind that we have been talking about this far. So let us look at the first data point, right? That is the chart on the top. This is the BSE Sensex index over approximately about this 18-20 month period. What we see here is that on 14th of Jan 2020, the BSE Sensex was what was at that time its all-time high. And then, as you all would recall, COVID started spreading around the world, including in India. We got our first case, I think, on the 27th of Jan. Another market started falling because of these risks. And then by about 23rd or 24th of March, the market had corrected by 38%, right? In a very short span of time, that is less than 2 months, the market is down 38%. And then on 24th of March came the announcement of the nationwide lockdown in India. Naturally, everybody, including all economists, all commentators, all stock market experts, everybody thought that the things will only get worse from here. And it was natural to think like that. But what really did happen? That day, the market actually bottomed in the sense that was the lowest point the market reached. And since then, we are seeing that the market has consistently been going up. Today, the returns from that point are more than 100%, right? So we are at, I think, 60,000 on the index today. That's more than 100% return since the low of March 2020. What this tells you is that whenever you think that you know what's going to happen, it's not necessarily the case, because there are obviously a lot of moving parts. Now, how do you avoid this kind of risk where knowing not what to buy and what not to buy is buying great quality companies? Now, let us give more weight to this argument. So here on the table on the right, we have 4 stocks, 2 stocks which we call as consistent compounders, right? Good quality companies. And we take 2 sets of investors. The first is a person who thinks that he or she can time the market perfectly, right? Buying the stock at the annual low every year, and they do it for 10 years in a row, right? So 10 investments at the exact 52-week low of a stock. And then there's somebody else who knows that he or she can't time the market. Instead, rather than bothering about all of this, I'm going to invest on the random date of the year. The first Jan of every year, this person makes a similar investment for 10 years in a row again. At the end of 10 years, both of these people compare their returns. So the perfect timer in HDFC Bank earns about a 23% compounded return at the end of 10 years. The random date person gets a 21.2% return, right? So 10 years of perfect timing, right, gets this person just 1.8% excess returns. Right. Similarly, with Asian Paints, it is 28.9 for the market timer and 27.5 for the person choosing the random date. That is 1.4% differential. So the point that we are trying to make here is that as long as you focus on, one is avoiding risky stocks, second is finding quality stocks, finding consistent compounders, then it does not matter when you buy the stock, what price you buy the stock, what timing, nothing matters. Just focus on, one is selecting good stocks, investing in them regularly, and holding them for the long term. Right? So that's the summary of all of this. Now, just to kind of give you how this all ends up into an outcome for all of us, I'll request Saurabh to conclude.
Thanks, Rakshit. Thanks, Salil. Thank you very much. So, folks, what are we trying to say here? What are we trying to say in the book, and why are we saying this to you at this juncture when you stand on the cusp of graduating from a great institution and going on to what I'm sure will be a very successful career in investing? We're trying to tell you that there's a 3-step process to investing in India. It's up to you whether you want to follow this process or some other process. We can only share with you what we do. So our 3-step process says, the process which we have laid out in Diamonds in the Dust is, you should end up investing in companies where the promoter does not steal your money, right? Sounds obvious, but a lot of fund managers in India don't understand this. They consistently invest with promoters who steal their money. So the first thing, invest with promoters who are not going to steal your money. Secondly, invest with promoters who are not going to take your money and put it in irrational projects, right? So look for good capital allocators, look for good accounting quality. And thirdly, not only do you want to invest with clean promoters, not only should they be good capital allocators, you also want them to have pricing power. No point giving your money to a company which simply doesn't have pricing power, which gives away discounted airline tickets, phone calls, flats, and so on. Right? Again, a bizarre sort of fetish and fixation, which we see with some fund managers, both in the listed and unlisted world, this bizarre fixation of investing in companies who don't have any pricing power, who don't have a franchise of any sort. Now, if you do the Marcellus style of investing, you get decent results. If you do this traditional desi investing, which is corrupt promoters with weak pricing power, with poor capital allocation, you get consistent disappointment. So the fellow on the right-hand side, right? So the disappointed-looking fellow on the right-hand side of the screen is what the standard Indian investor gets: consistent disappointment. And what we are advocating, what we do with the best part of the couple of $1 billion that we look after is the consistent compounding approach, clean accounts, good capital allocation, strong franchises, strong pricing power, and you compound it consistently more than 20%. As Salil told you, you don't have to wake up in the morning and look at your phone to see if God sent you a text message about timing the market. A lot of fund managers do that. Every morning, they check their phone to see if there's a WhatsApp message from the Almighty about, kab ghusna hai, kab nikalna hai. We don't believe in any of that nonsense. So clean, rational, dominant, and you're on your way to consistently compounding your wealth, your clients' wealth. Right now, whilst we've written the book, we also understand that you guys are pressed for time, right? So you'll say that, chalo, it's all very good for Marcellus to write these books, but boss, time kidhar hai? I'm sitting for all these exams, job interview bhi dalne ka hai, right? So time nahi hai padhne ke liye. So that we can give you a bit of a chavanprash, a bit of a tonic to read the book rather than blowing your brains out in WhatsApp, so that we can give you a bit of a tonic to read the book. We got the man who taught us much of what we know, a man called Sir John K. We got Sir John to write the foreword of the book, so that we could give you a bit of a tonic to encourage you, to motivate you to read the book. So in the foreword of Diamonds in the Dust, Sir John says, and I'll quote from the foreword, he says, "No one said successful investment was easy. No one said successful investment was easy, but this book will lead you carefully through the underlying principles of successful investing. You will learn to see through deceptive accounting. You will not learn how to time the market." I stress, folks, you will not learn how to time the market, but you will learn that even if you are able to do so with some prescience no one else has ever achieved, the returns from market timing are far less than the returns from effective stock picking. You will learn the nature of comparative advantage and how to identify sources of comparative advantage that are appropriable and sustainable. Right? To invest well, you must understand these things. And Sir John ends the foreword by saying, "I hope this book will encourage people to take control of their own wealth management." So folks, that's Diamonds in the Dust. Thank you very much for giving us a chance to present our work to you on this Saturday evening. So we got a little bit of time. If any of you have questions, happy to take them. And back to the organizers, how do you guys want to go about the Q&A?
Thank you, sir. That was indeed a very riveting discussion and it had us hooked till the end. So we do have some questions for you. So the first question that we have is, what do you think about the merger of HDFC Bank and HDFC Limited? What would be its overall impact on the banking sector and does it consolidate PSU banks too?
Okay, so we'll talk about HDFC Bank and HDFC Limited. So one thing, folks, you'll learn very early in your career is don't get lost in intergalactic affairs, right? So unless one of you is going to sit on the board of a PSU bank, I hope none of you has to do that. It'd be quite a difficult task to sit on the board of a PSU bank. And unless one of you is aspiring to sit on the board of a PSU bank or one of you is interviewing at a PSU bank, I don't think you need to concern yourself with intergalactic affairs. So Afra's question had three parts. She started with HDFC Bank, and she ended up with a completely relevant topic. It's not Afra's fault. It's not whoever who asked their fault. It's the way our country works, right? So people will be sitting at home. They'll be thinking about Russia, Ukraine ka kya hoga? Some other person will be thinking global warming se kya hoga? Right? Another dude will be saying asteroid could hit the planet. Usse kya hoga? So there's this bizarre tendency in investing in India to think about subject matters which are in the domain of the gods, right? We simply are not in that pay grade. So we focus on mundane things. So let's focus on something mundane, which is germane for us, which is relevant for us, given that we own several thousand crores of HDFC Bank. Rakshit, do you want to talk about your thoughts on the merger of HDFC Limited and HDFC Bank, Rakshit?
Sure, Saurabh. So, look, I mean, there are 3 or 4 business-related operational benefits to this merger, which is quite interesting. The first one is there are massive cross-sell opportunities, right? So currently about 70% of HDFC Limited customers, they do not have HDFC Bank's CASA, right? Current account, savings accounts, and hence there's a massive cross-sell opportunity from HDFC Bank to HDFC Limited's customers from there. Secondly, 70% of HDFC Bank's customers, they don't have a mortgage, and hence there's a massive loan cross-sell opportunity as well there, right? So that's one part which the segregated entities didn't have in as big a detail, as big a muscle as they will now. Second is this also is likely to be return on asset ROA accretive. So there's a 2.5% differential in the cost of funds between HDFC Bank and HDFC Limited, and hence currently HDFC Limited is making 2% ROA on the core housing business despite the cost of funds differential. Of the 2.5% funds advantage, liability cost of funds advantage, around 2% will be consumed due to the CRR, SLR, priority sector lending type of requirements, and also higher cost of operations of HDFC Bank, which naturally has a higher cost to income ratio compared to an NBFC like HDFC Limited. So net, there's a small benefit once you consider the offsetting factors. Then the next layer of synergy is that in the largest segment of retail loans, which is home loans, which is also one of the fastest growing segment of retail assets in the industry, HDFC Bank has just 2 or 3% market share. Right? When you compare this against, let's say, the market share of SBI, which is 22% in that home loan industry for retail assets, ICICI Bank has 11%, Axis has 7%. HDFC Bank's 2-3% market share is minuscule, and the consolidated entity, as a result, will have a leadership position in the fastest growing aspect of retail assets, and also worth understanding that the short tenure loan book of HDFC Bank currently, prior to the merger, short tenure loan book means that roughly in 2 to 2.5 years, the entire loan book has to be renewed because it runs off because it's short tail, right? Versus HDFC Limited, which brings in long tail assets, and hence the loan book doesn't run off so quickly, right? So as a result, the amount of firepower that HDFC Bank currently has to ensure that every year literally 40% of the loan book gets renewed, that same firepower can bring in longer tailed assets and hence bring in more efficiencies as well. So those are the bunch of operational efficiencies. There are a couple of sort of regulatory related uncertainties which are yet to be ironed out. But net, we see these to be playing out positively for HDFC Bank shareholders.
Thank you so much, sir. Moving on to the next question. With the current geopolitical situation, what advice can you give to new investors to keep floating on such a market and prevent the loss of capital?
You've got no idea about geopolitics, Ruchi. We didn't talk about geopolitics at all, no. So, call, say, the Indian Foreign Service or something like that. Yeah, I mean, it's beyond our pay grade. We explain what we do, right? Clean companies, good management team, rational capital allocation, and high barriers to entry, right? So, folks, I'll tell you this again. We tried to explain this in the last 40 minutes. And if you listen to our webinars or read our books, we'll say this again and again. Focus on what is relevant. Don't kill yourself focusing on boiling the ocean. If you boil the ocean, you'll boil the ocean for a long time to come. And if people ask you these questions at job interviews, right? From what I understand, these sorts of questions are quite common in job interviews. Tell them to focus on their jobs rather than asking you questions about subjects like this, which is beyond the domain or competence of any fund manager. Or indeed, forget the fund managers. Most promoters also will have no idea about geopolitics. They shouldn't. If I am running a toy factory as a promoter, or I'm making baby milk powder or undergarments, how am I supposed to know about geopolitics, Russia, Ukraine? It is actually quite interesting that you see promoters in our country opining on these things. Never understood why they do it. But anyway, don't get carried away by them doing it. Focus on what's relevant for you. I presume you guys are being taught by the best teachers in economics, in finance, in commerce in the country. Learn from them, economics, commerce, finance. Learn to read financial statements. Learn to understand the economy. Don't get lost in these debates which are simply beyond our pay grade.
Thank you, sir. So the next question is, you mentioned that it's important to invest in companies who do not have dodgy accounting processes. So how can retail investors evaluate the legitimacy of these books, since they assume that these errors to be non-existent, given that they are audited by renowned accounting firms?
That's nicely put. So Salil, do you want to take that?
Yes, yes, sir. So, on the last part of the question is that these are audited by renowned accounting firms. All the case studies that we showed earlier, they all had a common trait, that is, they were all audited by renowned accounting firms. Okay, so don't just blindly assume that is something which you should completely bank on, because business owners find out creative ways of fudging numbers. Anyway, that apart, so there are 2-3 simple things you can do, right? First is if you don't know anything about accounting and finance, right? Just focus on 3 things. First thing, open a company's annual report, or actually open 3 years of annual reports and try and read them as much as you can. And within that, we look for first, we look for what is the board of directors made of, right? Do you see people who are, one is qualified for the job, in the sense that if it's a business related to, let's sort of say, making toys or baby food, the board of directors come with experience in consumer products, or experience in, say, marketing, or some technical aspect of manufacturing. So basically, you need a board of directors which has the technical expertise and the experience to guide the company and the company's management on doing work. If the board is made up of people who you think are unknown names, possible friends, family members of the promoters, then that's a red flag for you, right? Keep that company on the side. The second thing you want to check for is related party accounts. Again, this related party transactions. Sorry. Now, again, this is very clearly mentioned in every annual report. If you see that the company in question has a lot of transactions, right, purchases, sales, renting property from these which are owned by the promoters, that again is a red flag for you, because this is the easiest way to kind of take money out of the company into the hands or the pockets of the promoters. So look for what is the intensity of related party transactions, right, in the overall size of the scale of the business. The third thing is open the cash flow statements, again, very clearly available in every annual report, and see if this company is making, number one, most important is, are they making cash flow from operations, in the sense that is that a positive number? Cash flow from operations, what it tells you is that regular business, right, buying and selling stuff, whatever the core business is, in that they're making cash or not, right? Accounting can always show you a profit, because there are creative ways to do this. You people will all learn or already learning. Cash is real, right? Cash is a fact, you can't change that. So the cash flow from operations should be positive number. Even better, cash flow from operations plus cash flow from investments should be a positive number. So basically you are investing for growth from the cash that you're generating from your existing business, which means that you're running a business which can kind of sustain its own growth well into the future. So just focus on these three simple things. If you find red flags in any of these, then don't waste your time in looking at that. If you think that all these three things check out, then obviously there's, if you're interested, you can go deeper into forensic accounting. The book has a set of accounting ratios. Here again, there are publicly available resources where you can check for these, and this will tell you whether there's something wrong or not. So in a way, very simple for even lay people.
Thank you, sir. If time permits, may we take up one last question?
Yeah, go for it.
Thank you, sir. If we cannot time the market, how do we get to know when to buy a stock? Can you please elaborate?
Salil, you want to take that up? Our favorite subject, when to buy, when to sell.
Yes, in fact, I think the whole point of this is that you don't think about this. You don't think when to buy, when to sell. So like you were saying, if what you need to do is you find those three traits in a company: clean accounting, rational capital allocation, and solid competitive advantages, right? Which is practically, like Saurabh was saying, in a way, these are dominant franchises or near monopolies. So once you have these three companies, then it does not matter when you buy them, right? And the reason is that because if you have a company, let's say, which is able to grow its cash flows, right? Let's use the word cash flows instead of profits. If the company is able to grow cash flows at, let's say, 20 or a 25% compounded rate annually, then even if you end up buying the stock at, what you think was an expensive, buy, or you bought when the market was at its high, then it won't matter over the long term, because it's the earnings compounding which actually drives the stock price, not necessarily the time of entry. In fact, for HDFC Bank and Asian Paints and many other stocks, which we call as consistent compounders, even if the first row that you see is buying at 52-week low, instead of this, if somebody had bought these stocks at the 52-week high, which is the annual high for every year, 10 years in a row, they would still have made about 19% compounded return, right? So what this tells you is that if you're focusing on buying good quality companies who exhibit those three traits, then it won't matter when you're buying them. So don't get trapped by the market is very high and you should not buy, or somebody you hear on the neighborhood or on TV that bahut garam hai market, right? That's a very Bombay phrase that you keep hearing, and you should not buy, and geopolitical, you don't know what's going to happen and so on. No, focus on buying good companies, and that takes away the problem of when to buy completely.
So folks, just to sort of put this in context, right? You can see on this little table that we have put here, suppose you're the world's greatest market timer, right? Suppose you have a God-given ability every year to buy, say, Tata Steel at the year's low, and say you buy Tata Steel 10 years consecutively, last 10 years at the year's low, आपका return आएगा 15%, right? Now, Asian Paints, as Salil told you, even if you buy it on 1st Jan, random date you buy it, you compound at 28. Let's assume you're not even that good. Let's assume you buy Asian Paints every year at the year's high. As we show in chapter 6 of Diamonds in the Dust, if you bought Asian Paints for the last 10 years at the year's high, right, 10 saal lagatar at the year's high, you'd compound it with Asian Paints at 19%. And this is what we mean when John K says, or we say, that stock selection matters more than market timing. And by the way, Tata Steel is not some dud franchise. This is India's oldest and most powerful steel franchise, famously famously strong company because they have almost free ore, free coal in Jamshedpur, right? So company as powerful as this, because the capital allocation hasn't been the greatest, the nurturing of comparative advantages hasn't been the greatest. Even if you time it perfectly, आपको 15% मिलेगा. You mistime Asian Paints perfectly, you'll get 19. And that's why this whole point that even if you had this great insight on market timing, आप बिल्कुल right time पे घुसे, बिल्कुल right time पे निकले, it doesn't make that much of a difference. What makes difference, the greater skill to cultivate in investing, and you're the right audience to do so. You're studying at one of India's most prestigious colleges. You're being taught, I presume, by the best teachers in the country. The skill you should try to cultivate, and you guys start now. By the time you are our age, you'll be far better than we are at it. The skill to cultivate is identifying great franchises, loading up and staying invested rather than trying to time markets.
Thank you so much, sir. I would like to thank all our speakers for an intriguing discussion. I believe I speak for everyone when I say we got to learn immensely. The Economic Society SRCC is grateful to all our panelists for taking out time from their busy schedules for the summit.